All right, so we are starting the new week of trading with some excited traders and investors on Wall Street buying into some of the beaten up stocks. But one of the big themes this year has been whether or not investors will feel the same level of conviction in U.S. equities going forward as they had, as an example, last year. Michael Capombassis is joining us now. He's president and chair of the investment committee at Bristol Gate Capital Partners. Michael, it's good to see you. Thank you very much for joining us. And, you look at this enthusiasm in the market today and you wonder, oh, is that a sign that, the correction worries are over, that investors are going to jump back into U.S. equities, or are we in a different moment for these markets after the run-up that we had already seen in a lot of those high flyers?
John, thanks. It's nice to be here with you, and it was a great pronunciation of my last name, which most folks don't get right, so appreciate that. I would say this, and this is a bit of a hedge response, but under the new Trump 2.0 U.S. administration, it is so hard to handicap the path forward. And I think if we continue to plod along in terms of a pause here or a delay here with respect to tariffs, and this sector or these goods and services are going to be tariffed, these are going to be exempt, how much are they going to be tariffed? It seems to change on a daily basis, and it's so hard to keep track of. I think in that scenario, equity markets have further to fall, whether it's another 5 or 10%, I don't know, but further to fall. And taking that one step further, if we get into a protracted trade war with the U.S. and its major trading partners, well, that's unambiguously bad for everything, for the economy, for consumers, businesses, and certainly equity markets. On the flip side, as we've seen a little bit today, if we can make some tangible, true progress in terms of a long-lasting resolution to all these trade disputes between the U.S. and its trading partners, that has a wonderful backdrop to the equity markets for the path ahead, because we've had this 10% correction, and it would be a wonderful entry point. So it's so hard to handicap, and as you see today, there's so much gloom and doom in the market. Even a hint of progress, like we saw today and yesterday, markets are off to a great start.
Yeah, and what do you make of the fact that, like, when we look at how the money has flowed this year, I'm looking in the U.S. market where actually some of the energy stocks have done well, but healthcare has done well, some of the utilities have done well. This is a day for tech to bounce, but tech has really lagged. And what have been your observations on where the money has been flowing?
Well, what we've seen is that the market in the U.S. has been broadening out, and that's a really good, healthy development. Last year, we had the most narrow market, the most concentrated market on record. The top 10 stocks in the S&P accounted for 40% of the index last year, and close to it right now. 7 stocks, the Mag 7, produced 60% of that 25% return we saw in the equity markets. We saw a bit of the broadening in Q3 last year, and we're starting to see it again this year. And so outside of those Mag 7 stocks, those 493, we're seeing better participation this year. The S&P 500 equally weighted benchmark has outperformed the market cap for the first time in a while. We think that will continue. And part of the reason for the catalyst for that is that the Mag 7 were so strong last year because they had the most pronounced earnings growth. Collectively, it was about 33% earnings growth in 24. The rest of the market was at 4. So it's understandable you see that kind of divergence in performance. This year, Wall Street is looking for the Mag 7 to produce about 20% earnings growth, so still very good. But the 493 are going to be above 10%. So you're starting to see that bogey converge. If that happens, like we're seeing year to date, there will be a broadening of the equity market, which is great for equity markets in terms of more companies that are supporting the overall index.
If someone were to go forward in time and tell me a decade from now that, tech was still your big friend because they had all this profit power more so than anybody else, I probably wouldn't be surprised. But I think timing is always important, especially if you're, older in age, you're managing your income year to year. And I think that given the volatility, I'm sure a lot of people are trying to pinpoint the companies that might have less volatility, but also might be paying you to wait, or at least be paying you in the interim. In other words, they're income providers, they're companies known for dividends. How would you describe the environment for companies that not only have proven track records with paying dividends, but maybe have the muscle to continue boosting their dividend payments?
I think that's a great question. And we at Bristol Gate Capital, we are passionate dividend growth investors.
Okay.
We're actually high dividend growth investors. So we're looking for the highest dividend growth. We're agnostic to yield, looking forward, that companies that can persistently raise their payout amounts every year. And so those companies have been neglected in the markets for a while now. That's starting to change. But when it comes to the environments that we're in now, we think it's a great place to have some more exposure to outside of these tech-dominated areas of the equity markets. It's not to say that NVIDIA is not a great company, or Apple's not a great company, or Amazon's not a great company, but you can have too much of a good thing, as we've seen year to date with the Mag 7 rolling over to a certain extent. And so dividend areas of the equity market, certainly in the U.S., are very attractive right now. They haven't participated in the rally we saw last year to a large extent. So you can get some excellent values and entry points for great dividend growth companies that, if you're a long-term investor, is going to turn out really well for folks.
I always like to be a little more actionable if we can for our audience. I mean, is there an example of an industry or individual companies that would sort of highlight that to you?
So right now, I mean, our portfolio in the U.S. is 22 high conviction ideas. And we're generally sector agnostic in terms of where we look. We just go where the best dividend growth is. But we are overweight both healthcare and industrials right now.
Okay.
And healthcare was one of the worst performing sectors last year in the United States, which is unsurprising during a presidential election year. They tend to get beat up. But we own some wonderful, high-quality dividend growth companies in the healthcare space. Names like Zoetis, which is the global leader in animal healthcare. You know, companion pets, dogs and cats, and commercial herds. I mean, I have a Bernese Mountain Dog named Lola. I take her to the vet.
My dog's named Lola, too.
I take her to the vet, John, way more than I ever took my kids to the doctor. So that's a wonderful business. We own Thermo Fisher, which is a leader in life sciences. Hasn't done much in the last year. We think it's a great entry point. And earlier this year, we were able to pick up Eli Lilly, post a 25% pullback. That's one of the leaders in the GLP-1 franchise.
Wow, I didn't realize it had pulled back that much. Yeah.
It did early this year. So we picked it up in early January. And, you know, that has a massive opportunity, no pun intended, in front of it with weight loss and with, you know, the diabetes franchise.
Yeah, no, it is. And you do see that even in some of the estimates from Bloomberg on potential dividend growth from here. I guess if people are trying to figure out what's the one thing you should think about for a more rattled market, because you did allude to you would not be surprised if you saw more downside in stocks. What would be the determining factor of that happening? What would you be looking for?
It would be just the continuation of this trade dispute. I mean, I hate to say it, I know you folks have been talking about it all morning.
Yeah.
But if we just plod along, or it gets worse, then there's downside to equity markets. It creates so much uncertainty and anxiety with consumers, with business people, with governments, that it's inevitable. I believe the markets will have further to fall. If we can, as I said, come to some kind of tangible, real resolutions around these issues that have some kind of persistency and long-lasting, then the backdrop is excellent, because we've had this nice, healthy correction, and there's a lot of areas of the market are cheaper than they have been in a while. And so if you're a long-term investor, it's a good place to be.
All right, Michael, appreciate your time. Michael Capombassis joining us, chair of the investment committee and president at Bristol Gate